Hey guys, welcome back. This is Toby Mathis, and today we're going to be talking about the 3 ways the rich use corporations to explode their wealth. Now, if this is your first time here, please like and subscribe. Put these videos out probably 2-3 times a week, and you could always share them with anybody that you believe would benefit from this content. But let's dive in. Number 1. A lot of people are used to corporations like in the stock market and using it for business. It's not what we're talking about today in the traditional sense. What we're going to be specifically talking about is how you as an individual, and specifically we're going to talk about what wealthy families have done and why they're doing it, how they use corporations to get additional benefits that allow them to expand their legacies, grow their investments, and actually keep uniformity in their estates so that it doesn't get squandered by future generations. So we're going to talk about that as we dive in. Now, right out the gate, I want to talk about corporations in general. When I say corporations, I mean from a tax standpoint corporations. It could be an LLC taxed as an S Corp. It could be an LLC taxed as a C Corp. It could be a S Corp. It could be a C Corp. Most of the time when we are setting up a corporation, it's going to be under a state. They're creatures of state law. And you are going to designate how it is treated from a tax standpoint. And it doesn't matter whether it's a traditional corporation or an LLC. We are talking about the tax designation. Now, an S Corp flows through to the individual, and we're going to talk about that in some cases, versus a C Corp that pays its own tax. And when I say flows through, I mean net profit, the net income after expenses that flows down and somebody has to pay tax on. When you have an S corporation or an LLC taxed as an S corporation, those profits flow down to the shareholders, and the shareholders recognize that income on their tax bracket or whatever they might be. So it might be 0, it might be 12%, it might be 37%. If you add state taxes on there, it could even be higher, right? Whereas a C Corp is a flat 21%, and then if it pays out its profits in the form of a dividend, there may be a tax consequence. Usually, for small, closely held C corporations or LLCs taxed as C corps, it's going to be taxed as long-term capital gains when you receive it as a qualified dividend. And so again, if depending on your tax bracket, it may be taxed at the 0% tax, it may be 15%, 20%. It just depends on the recipient's financial situation. But we want to get into what are the 3 big ways that the wealthy and the rich use these corporations. And I'm just going to call it, like some people call it, a family office or a management corporation or a family corporation. But one of the reasons that they're putting this in place, and it generally looks like this, let's just say 3 ways. Generally speaking, you have a family, like let's just say we have a couple here, and they may have some real estate investments, and maybe they have a real estate holding entity. Generally speaking, that's going to be in Wyoming. If you want to learn more about that, obviously I have videos on that topic. But you're going to have their real estate. Maybe they have a whole bunch of sub-LLCs that are feeding into that. They may have some stocks and bonds and some cash. And what we're doing is we're putting a management entity over the whole thing, which is the corp, to manage those LLCs. It may even have another business over here, your side biz, that it's also managing or owning. Maybe it's a subsidiary. But in any case, what we're doing is we're isolating the investment activities out so that they can continue to grow. And we're using that corporation for centralized management. So when we start diving in, what are the benefits that come out? The first type of benefit that comes out of this scenario by setting this structure up is taxes. And let me explain how. Maybe it's you, maybe you have your kids. We'll throw some kids in here. Maybe you have some siblings. Maybe you have siblings over here, parents, whatever. You have people that are in your family. You could actually put them up here onto your board of directors, right? You could actually make them a part of the team that is making decisions, overseeing the entirety of your business. Now, under certain circumstances, they qualify as employees. Now, being a board member may not qualify by itself, but if they're doing something on behalf of the business, then you could actually start to pay them out of that business. Or better yet, you say, hey, it's an unpaid position, but we'll reimburse your expenses that you incur because you're working with the corporation. And here's the magic. If you're an employee of a business, that business can reimburse you for things tax-free, unreported. Let me explain this. And I didn't misstate that. It is not reportable income. It is not included on your tax return. It's not included for calculations of employment taxes. It's not subject to withholding if they reimburse you for expenses. We're all used to doing this. Let's say you're at your job, maybe you do a 9 to 5 and you're a W-2 employee, or maybe you were at one point, and your boss says, hey, Toby, on the way to work, will you pick up some donuts? And so I hit Krispy Kreme on the way to work, buy $20 worth of donuts. And I get into the office and they write me a check for $20. Where do I report that? Are they going to give me a 1099? Do they include it in my pay? No. That was a reimbursement under an accountable plan. They reimbursed me for a business expense. The business incurred that expense. They're going to write off that expense as part of their business. Now, if I am on that board and I'm working for that company as an employee, now that corporation can do the same thing for me. What types of expenses do we get? Anything that would benefit that business and its endeavors to make profit would be deductible. It's called a 162, all ordinary and necessary business deductions. What are the most common? Like your cell phone, your computer, your internet, an administrative office for your house. Maybe the corporation's using your home under the Augusta Rule 280A. You've probably heard about this. 14 days, they could have meetings in your house. It could pay you that you don't have to recognize as income. It gets it as a deduction. You can literally give yourself $10,000 to $15,000 a year pretty easily, not having to pay tax on it. Corporation gets it as a deduction. These are all things under an accountable plan. Anything that you're incurring education-wise. Hey, I'm running all these different businesses. I need to learn how to create my legacy, so I start going to courses, etc. All of those become tax deductible. So I'm going to put that as number one. You get major tax deductions, and it's things that you're probably already paying money for. So for example, if your kids, right now, you're having to pay for their cell phone and their computers and everything else, you're paying for that, and it looks like this. If it's you have to earn money, then you pay tax, and then you spend what is left. On average, taxes in this country are about 30% when you add them up. Federal, state, employment taxes, everything that you add up, on average, according to the Tax Foundation, it's actually 29%. I'm just going to say 30% so I can do easy math. So if I want to spend $1, I'm going to have to make X times 30 minus that 30, whatever. So I'm going to have to make probably about $1.40 or thereabouts in order to have $1 left to spend. In other words, I'm getting hit with a tax bill every single time. To make it even easier, let's just say it's a third. So it's for every $1 I want to spend, I got to make $1.50. That's what most of us, that's our situation. So when I'm paying for the kid's computer, and I bought a $1,000 computer, it wasn't $1,000, it was $1,500 because I had to make $1,500 for my employer, and then they took taxes away. I had to pay my federal taxes, my state taxes, my Social Security taxes, my Medicare taxes. All of those different taxes come out, and then I get to do it. Now in a business, it's different. They earn money, then they spend money, then they're taxed on what is left. Hopefully you guys can see that. It earns money, it spends it, and then it's taxed on what is left. In other words, these two guys change spots. So if I have a business and I can expense that, I can spend money on my kids' computers, cell phone, internet, so that I can get a hold of them because they're part of my business. Travel, if we go places, like if we go to a retreat, or we go learn, or we're going to go to a course somewhere, or we're visiting someplace that's part of our business. Hey, we're actually investors. And like, for example, I have properties in Houston, in Baltimore, Winston-Salem, Indianapolis, lots of different places, Las Vegas. If you want to go visit those locations and visit your properties, that becomes tax deductible. So you may start saying, hey, maybe I want to invest in some really nice properties in Tampa or Miami, right? They may not cash flow, but they'll give you an excuse to go. Now, all of a sudden, you could start covering those expenses with pre-tax dollars. You start putting it over here where we're spending it before it is taxed, and we're able to save that money. Let me give you an example also. If you're doing real estate and you have kids that are less than 18 years old, you don't have to do withholdings on them or anything like that. You could actually start paying them. And if it's less than the standard deduction, which this year is $14,600, not only do you not have to do withholding and report it, but they won't have to even file a tax return, and there's no tax, but it's a deduction and it lowers your taxable income. The rich understand how to use these. That's what I'm getting at. From a tax standpoint, there's probably $10,000 to $15,000 a year. On average for us, it's a little over 20-some thousand for our typical clients that they're already paying, that we get released as deductible expenses simply because we start to characterize it in a fashion that is more beneficial to the taxpayer. And here's the rub. You're allowed to do this. Tax avoidance, 100% legal. You're allowed to structure your affairs to pay the least amount required under the law. Evasion is a completely different animal. If you're just not paying taxes, you're going to find yourself in trouble. But you can structure yourself similarly to how the wealthy do it, so that they have a management company that allows you to get these benefits. Now, why would you do this? Why would I do this? I might be doing this because I may have to care for family members. I may have dependents. And depending on the type of structure I put in place, like if I use a C Corp, for example, I can reimburse 100% of medical, dental, vision expenses for the employee and their dependents. So if I have a dependent, for example, that has medical needs that are coming out of my pocket, not covered by insurance, but covered out of my pocket. Maybe I have co-pays, maybe I have huge deductibles, maybe I have things that are not covered, and it's $20,000, $25,000, $30,000 a year. I probably want to make that into a C Corp. Most accountants are going to say, let's start with the idea that it's an S Corp because it's a flow through, and all we're using it for is the expenses. And at the end of the day, if there's anything that flows through, we're really trying to zero it out. If you have a traditional business, we may do a calculation as to what do the employment taxes look like, and we might be using a corporation to minimize the employment taxes. And let me just give you an example. If I have two types of businesses over here, one's a sole proprietorship, one is an S Corp. And so I'm just going to use SP and S. Let's say that $100,000 comes into both from a business. So I have $100,000. If I'm a sole proprietor, 100% of that is going on my Schedule C and is subject to Social Security. I'm going to call it SE because it's called self-employment taxes. It's 15.3% plus my federal taxes plus my state. So you end up getting hit with you get a partial deduction, so it ends up, the math is about 14.1%. I'm going to pay employment taxes of about $14,000. It's different in an S Corp. In an S Corp, I'm only looking at the profit that flows down, and I can pay myself a wage over here to reduce the amount of profit. I'm required to do this if this flows down to me. The profit is only federally taxed, state taxed. No SE tax. I avoid the employment taxes entirely. But if I'm taking distributions out, I have to pay myself a wage. What does that mean? It means that if I have $100,000 coming in, I'm probably paying myself, most accountants are going to say about a third. The actual rule is reasonable compensation, although for 25 years I've never had to litigate this. And generally speaking, pigs get fat, hogs get slaughtered, right? Just be reasonable. A third is what the courts tend to give, so that's where most people go. But again, I've never seen that get audited. In fact, these guys over here are audited at about 1.5%. Last year we had data on 100,000, yeah, it'd be about 1.4%, 0.1% over here. So these guys are literally 1,400% more likely to get audited. And then because of the way S corporations operate, they're kind of willy-nilly, loosey-goosey. A lot of accountants set them up because they don't want to actually keep track of the financials, which means you shouldn't be doing it at all. And they lose their audits about 95% of the time over here. Over here we do much, much better because you actually formalize the business. You take a small wage, and let's just say 70% of the money flows out without having to pay the employment tax. That's going to save you roughly $9,000 to $10,000 per year. Plus you get all the other tax benefits. So if you are running a traditional business out of it with your family, there's that factor, and you get to choose what's the best situation for you. And that's number one. Huge tax benefits. Number two, centralized management. I'm just going to put centralized management, MT. When you put a corporation that actually starts managing your structure, what you've done is you started to consolidate the decision-making into an entity. Why is this important, and why do the rich think this is important? Because if you start building up substantial assets, you want to make sure that you're not creating a burden on your family. And let me explain it like this. Money is no different than this clipboard. This clipboard seems really light, but if I hold it out here at the end of my hand, and you check with me in about 10 minutes, my arm's going to be shaking. I'm barely going to be able to continue to hold that because it's the leverage of it, the pressure of it. It seems light until you're handing it to somebody, and if they're not prepared to what they do with it, so like if I don't know what to do with this, and I'm holding this out here, check with me in an hour. I don't even know if I could keep my arm out for an hour, right? You're going to be suffering in all sorts of ways. You want to have a place that you're going to be putting it. You need to have a plan of attack. You can create that during your lifetime. You could teach your kids, here's what we do. Here's how things operate. You can build your estate plan. So for example, I would use a living trust to cover all of this. And I would have very clear instructions not to dismantle my investments, to keep them going. And by having the family involved in that corporation during my lifetime, it would literally be, if something happened to me, nothing would happen. They would just keep operating the business because I taught them how to make those decisions by being part of my management corporation. Did I give them anything? No, I gave them some tax benefits, but I didn't give them houses. I didn't give them a bunch of businesses. I didn't give them a bunch of things. You could still do that. But I'm saying is that here you could actually teach them to manage your businesses and your investments during your lifetime without transferring it to them. I wish I had a nickel every time I heard about somebody saying, I'm just going to give it to my son and my daughter and blah, blah, blah. I'll start giving it during my lifetime or whatnot. And I'm like, if you give it to them, understand that it's gone. You don't get access to it anymore. I give it to them, they have a bad divorce, or they get into a car accident, or they get sued, or they have an alcohol problem, or they have drug problem, or they just have a broken picker and they keep picking 20 spouses, right? They're just going through them and they're getting divorces all over the place. Those assets now are part of their estate and can be depleted. And that would really suck to be watching that if you're the one that gave it to them. Oh my gosh, what's going on, right? You're much better to keep it in a structure like this, and you have that corporation managing it, and you're just teaching them how to operate it. And if they have a problem, I can cut them off. If they go through a divorce, you're not entitled to anything, right? I can either help you or I cannot, but somebody can't force you to say, hey, they're on the board of that corp and they should be getting paid more. No, it doesn't work that way. I could release them tomorrow. Sorry, we don't like board members that are going through litigation, right? You could absolutely do that. Plus, if you're using it for tax benefits, you're probably not paying them anything anyway. Like maybe there's some but maybe you're using it to fund a 401k, things like that. But realistically, no, they're not entitled to it. So if something happens, it's not a big deal. Now, number 3, and this is the big one. And we see this over and over again, is the transitioning generations. I bring in not just my kids, maybe I'm bringing in siblings, maybe I'm bringing in their children, my grandkids, maybe you're old enough to where it's great-grandkids, but you're transitioning and you're teaching everybody how to operate the business. There's an old adage that the first generation makes it, the second generation maintains it, and the third generation blows it. Statistically speaking, it doesn't look very good for people that get windfall. Remember when I said you're holding the clipboard out and it starts to make your arm shake? Statistically speaking, most estates are gone within 2 generations, 3 generations, they're getting blown up. This is how you prevent that from happening, is you teach them and you put a vehicle in place to where whoever is in charge of this controls the businesses and can prevent somebody from making mistakes. And I know a lot of you guys are like, oh, but my kids, they're super smart. I'm not worried about your kids. The kids are probably super smart, but we don't know who their spouses are, what their situations are going to be, or what their kids are going to be like, or what their kids are going to be like. And when you're creating a legacy, you don't want to leave it to chance. You actually want to make it formalized structure. And generally speaking, if we're using a trust to hold this thing, we're not distributing the assets out to somebody so they can go buy a Ferrari or a Lamborghini. We're having the assets held and there's income being distributed need-based so that you allow it to continue to grow so that your future generations all have the opportunities to go to school or to get whatever education you believe or whatever benefits you want. Some people want people to travel, so they put in their trust. Hey, I want to make sure that you guys leave the country once a year for at least 7 days, 14 days, go travel the world, see what that's like. That could be part of this, and it could actually be being covered by the corporation that says, hey, we're going to be looking at other investments. We want you to travel, or we're going to do an annual retreat where we're going over our business. You could actually do this pretty intelligently, especially if you leave the country 7 days or less. If you have one business day, it's going to qualify as a business trip. So you go over there for a retreat and you say, here's why we're meeting. Maybe you're going to London, England, maybe you're going to Paris, maybe you're going to Berlin, maybe you're going to Mallorca, whatever the case is, you're going there to have a business meeting and you get your family and you actually go through the steps of talking about the different investments and you make it transparent so people can understand what it is that you're trying to accomplish. You do that and you've unleashed the superpowers of corporations. So if you like this type of content, please like and subscribe and share it with anybody else. If you have any comments, did I leave something out? Did I miss something? Or would you like something explained in greater detail? Please put it in the comments below. Good luck and God bless.